For the first time in years, smart money is moving away from U.S. stocks. The S&P 500 is down 2.1% year to date. International developed markets up 4.2%. A 6-point performance gap in just 10 weeks. In this video, I am going to explain exactly why this is happening, where the money is going, and the specific ETFs you can buy today to position yourself. This is Wealth Realist. 3 structural problems with U.S. stocks right now. Problem 1, U.S. stocks are dangerously overvalued. The S&P 500 trades at a price to earnings ratio of 22. The historical average is 16. That means U.S. stocks are 38% above their historical norm. Now compare that to the rest of the world. European stocks, 13 times earnings. Japan, 14 times. Emerging markets, 11 times. Same global companies, same earnings growth. You are just paying 30 to 50% less outside the U.S. At 22 times earnings, the S&P is priced for a perfect future. Wars are not perfect. Problem 2. The Iran war hits U.S. markets hardest. The U.S. is the world's largest oil consumer. Higher oil means higher costs for almost every U.S. company. Technology stocks, 30% of the S&P, have zero protection from an oil shock or war uncertainty. They are getting hit hardest. Meanwhile, the Federal Reserve cannot cut rates with inflation rising. Growth stocks are punished most in that environment. And war capital flows out of expensive markets and into undervalued ones. European energy companies Shell, Total Energies are profiting from this war. Gulf state markets are rising. Problem 3, dollar weakness. U.S. national debt at $34.5 trillion. Federal deficit, $1.8 trillion per year. More debt, more printing, weaker dollar. Here is the key. U.S. stocks are priced in dollars. When the dollar weakens, international assets gain value, automatically for global investors. Capital flows accelerate out of dollar assets. The U.S. dollar index has been trending lower since its 2022 peak. That is a structural tailwind for international stocks. So where is the money going? 5 markets outperforming the U.S. right now. Market 1, European stocks. P/E ratio of 13, 37% cheaper than U.S. stocks on the same earnings. Average dividend yield of 3.8%, double the S&P 500's dividend. And European energy majors Shell, Total Energies are directly profiting from $89 oil. The best ETFs, VIC, Vanguard European ECF, 420 companies, 0.09% fee, IG for Germany alone, EWU for UK exposure, or hedge, currency hedged if you are worried about the euro-dollar exchange rate. Market 2, Japan. The Tokyo Stock Exchange is in the middle of its biggest corporate reform in 30 years. Forcing companies to return cash to shareholders. P/E ratio of 14. Dozens of companies still trading below book value. Here's the signal that matters most. Warren Buffett has been buying Japanese trading companies since 2020. When Buffett invests somewhere, that is worth paying attention to. Best ETFs, huge for broad Japan exposure. DXJ, if you want currency hedged, removes the yen-dollar exchange risk. Market 3, emerging markets, P/E ratio of 11. 50% cheaper than U.S. stocks on the same earnings. India alone is projected to be the world's 3rd largest economy by 2030. GDP growing over 7% per year. Middle class expanding at historic speed. Tech sector booming. Brazil, oil, iron ore, agriculture, all rising with this conflict. Best ETFs, INDA for India specifically. VWO from Vanguard for 50-plus country exposure. Keep China under 5%. Geopolitical risk is real. Markets 4 and 5. Gulf states, the direct oil beneficiaries. Saudi Arabia, UAE, Qatar, all seeing rising government revenues. Dubai markets up 2.1% this week alone. ETFs, GCC ORXA for direct exposure, 3 to 5% max. And global dividend stocks. VIM and SHT, dividend yields of 3.8 to 4.2%. Dividends that grow above inflation. Cheap PE ratios at 15 times versus growth stocks at 25 plus. Income that keeps up with rising prices. Now exactly how much to put international and which ETFs to use. Here's the reality most U.S. investors miss. The U.S. stock market represents 60% of global market cap, but the United States is only 4% of the world's population. Most U.S. investors hold 90% in U.S. stocks. That is dangerously concentrated. My recommended targets: aggressive 20 to 35-year-olds, U.S. 60%, developed international 25, emerging 10, Gulf 5. Moderate 35 to 50, U.S. 55, developed international 25, dividend ETFs 12, emerging 8. The rule for everyone: stay above 50% U.S. Never abandon your home market completely. The best ETFs for international exposure right now: VXUS, Vanguard Total International, 7,900 companies across all non-U.S. markets, 0.07% fee, the most diversified single purchase available. AFA, iShares Developed Markets, 900 large companies. VGK, Europe focused, 3.8% dividend yield. Huge, Japan, Buffett endorsed. INDA, India only. High growth, higher volatility. VWO, Vanguard Emerging Markets, 50-plus countries, all available on Fidelity, Schwab, Vanguard, or Robinhood today. Minimum $1 to buy. The risks you must know. Currency risk: if the dollar strengthens, international gains shrink in dollar terms. Use currency-hedged ETFs like Hedge or DXJ if this concerns you. Political risk in emerging markets is real. Keep M below 15% total. Never go all in on a single country. Tax treatment: international dividends are taxed differently. Keep international exposure in your Roth IRA or 401k where possible. And timing: this is a 3 to 5 year minimum play. International stocks can underperform for periods before the valuation gap closes. Be patient. The history is clear. From 2002 to 2007, international developed markets returned 120%. The S&P 500 returned only 28%. A 92-point gap in the same period. The same valuation dynamic is setting up right now. Cheap international markets, expensive U.S. War-driven capital flows, dollar weakening. If this was useful, subscribe. New videos Monday, Wednesday, Friday. Next, best investments during a war, ranked 1 to 8. Free guide at everydaycalculators.com/free guide. This is Wealth Realist.